Okay, I'd like to welcome you to the third session of our conference. I hope you're enjoying today. It's a nice, beautiful sunshine out there. I hope you're enjoying our college campus. The first speaker of our third session is Professor Roberto Chang from Rutgers University. He is a distinguished professor of economics at Rutgers and a research associate at the National Bureau of Economic Research. Previously, Professor Chang has also served in the faculty of NYU, Princeton, Columbia, and the LSE. And I had also the chance to meet Professor Chang previously when I was a grad student at WashU, and I had the chance to attend his lectures on financial intermediation and crisis. And now I'm very happy to meet him again in person here at Williams. Professor Chang's research focuses on financial intermediation, monetary policy, banking panics, exchange rate regimes, and the macro impacts of financial friction. So his research is covering all different aspects of finance macro. He has served as associate editors previously at Journal of International Economics and Journal of Development Economics. And he has been also consultant for several central banks across the world, the IMF, World Bank, and other policy institutions. And today we are very happy to have him over to talk about inflation targeting. Roberto, the floor is yours.
Well, thank you, Buraj, for this very generous introduction. Thank you for the invitation to speak in this forum, and to Ken Kuttner, that we go back to good days and debates when we were both at the Federal Reserve, right? So I wanted to mention that because when Ken approached me to talk about these issues, he said, well, I would like you to discuss, for example, if what's going on with the macroeconomic monetary management in emerging economies, and to give you an overview of some developments there that I think are significant, and hopefully they are interesting because they highlight the interaction, the dialogue between academic research on the one hand and monetary policy design on the other. And I'm going to try to give you some kind of sense of why I think it's been important. I mean, I've been working on this field for a long time. In fact, my association with central banks goes back to many decades right now. Let me just say that my first job was at the Central Bank of Peru, where I am from. And since then, I've been talking to central bankers, and they've been teaching me a lot. And hopefully some of the stuff that I've produced has also influenced the way they think. So when I started thinking about this issue, well, I said, okay, it's actually, the world is full of bad news, right? So let me just start with some good news, right? A success story. So this is an article from Clarín. Clarín is one of the main papers, if not the main paper, from Argentina, that says, there is a country that just broke the record for low inflation. And it is in South America. And you may guess which one that is, right? I mean, in fact, it is Peru. Since 1997, Peru has never had two-digit inflation, right? So right now, I think the record is approaching 30 years of one-digit inflation per year, right? So that should be impressive, right? More impressive when you look at what happened before, right? This is the same series, right? But you can see that the conquest of inflation actually was not trivial, right? This is also so the graph that I showed you before was essentially the last part of the series, right? But as you may know, in 1990, for example, Peru's inflation rate went over 10,000% per year. These are numbers from the Peru Central Bank. And you may actually know that the conquest of inflation has been associated with a very extended period of prosperity in Peru, right? So I'm not going to deal with these issues of growth, for example, today. I mean, there have been good. Let me just say that Peru's GDP per capita more than doubled between 2000 and 2020, right? And so there's a lot of reasons why the Peruvian experience is remarkable. And it is an example, I'm going to argue, of excellent central banking, right? This is the same graph of annual inflation since February of 1997. The red box tells you what the inflation targeting regime in Peru was trying to accomplish, right? I mean, inflation target in Peru has been mostly centered around 2% with a tolerance band of 1 percentage points up and down. So you can see that most of the time, Peruvians have been successful, right? Quite successful. The obvious exceptions are 2008, that is associated with the global financial crisis, and the COVID crisis. But even then, they were quite successful in bringing inflation down to the target quite quickly. Okay? Associated with that, the Peruvian system has been associated with remarkable stability in the exchange rate. So I'm writing a book about the Peruvian economy in the last 25 years, and I noticed, okay, so in 2000, it was the exchange rate was 3.5 soles per dollar. Like a month ago, it was like 3.7 soles per dollar, right? So it has gone down in this case to 2.5 and then up. But however, when you're talking about like 25 years of exchange rate movements, then you have to say that this is remarkable, especially when you compare it with our neighbors, right? I mean, there's no other country that is close to this degree of stability in terms of inflation and exchange rate stability. Okay, so very quickly, I mean, we could actually spend the whole afternoon talking about what has been the secret of Peruvian success. I'm talking about success in terms of macroeconomic management, especially in the management of inflation and stability, right? I mean, the rest of the economy is very questionable, right? You may, for example, want to know that in spite of being the best country in March of 2020 in terms of financial position, robustness, equilibrium, and so on, Peru ended up being the worst country in the world for deaths per capita during COVID, right? So that's an indicator to tell you that, what I'm going to talk about is one part of the economy. It's not about, there's a difference between like stability and success in conquering inflation and the overall development problem, right? But in my view, the macroeconomic framework, stability, macrofinancial, that's a necessary condition, but not sufficient for development. But this being said, it is, in some sense, the monetary framework that I think you have to give a lot of credit for, and there are essentially 3 key moments in that framework. One is between 1992, end of 1992, and beginning of 1993, where 2 important laws in the country were passed. One was the central bank law, which gave independence to the central bank. And 1993, a new constitution was passed that, in particular, prohibited the central bank from financing the government, number one. So fiscal deficits were no longer allowed. Interestingly enough, I mean, yesterday, Chef Nem showed these graphs about, for example, what percentage of government debt was being held by the central bank. And if you look at the graph, then Peru was clearly an outlier, right? That had like a much lower amount of debt being held by the banking system than other countries in the same position, right? And that, in some sense, has been a consequence of the design of the whole system, right? The other part of the design is that the central bank was given a single mandate, which was price stability, right? And then in 2001, that price stability mandate was crystallized in a formal inflation targeting regime. Okay, so um, so the Constitution in particular said that the central bank exists for only one thing, right? Just to stabilize prices. Okay, and that's that. And then we can start talking about what this means in terms of the data and so on. There's, for example, the interesting article by Garriga and Rodriguez that mentions that IT's economies are associated with less inflation. The estimate is about 5 percentage points per year. But in any case, what I'm going to argue is, okay, so this is all great. But we want to understand a little better what it is that makes inflation targeting in Peru um, a successful regime, right? Because I mean, it's actually true. I mean, the economists, for example, I don't say that. The economist last year said, okay, so Milei should learn from Peru's economic success, right? Um, but what exactly is it that we have to learn, right? And I think that's a legitimate question because we just telling that you have to do inflation targeting like Peru is like saying you have to play tennis like Rafael Nadal, right? Um, right? I mean, this is Julio Velarde, the current president, who has been recognized by different publications as at some points as the best central banker of the world, right? So the point is that we want to understand why the Peruvian example has worked, partly because we might want not to actually depend on particular people as the president of the central bank, right? So right now, this is a big question about Peru, who is going to be the successor of Velarde and so on, right? But then also, other countries are being told, maybe what you need is a Julio Velarde. Well, but that's actually not a workable situation, a workable advice. It's not very useful, right? So what I'm going to try to ask is, or what we are currently trying to figure out is, exactly what it is that has worked, right? And that also is related to the observation, and that's related to what some of the talks that were early in the morning, in particular Luis's talk, that Peru's IT regime, as well as other inflation targeting regimes, they have not been textbook regimes, right? They have deviated from the canonical regime in various aspects, right? And therefore, you have to ask, well, is it inflation? What exactly is it? What kind of inflation targeting regime works better than others? What is it that actually makes a difference, right? That's what we should be asking, right? So, so what I want to talk about um, is about this issue. So, I mean, how is it that inflation targeting in emerging economies, what's the theory and what's the evidence, what's the actual practice, right? And how to reconcile these deviations, right? I'm going to argue that one way to reconcile that difference, the discrepancies, is that there are aspects of developing economies that are different from from advanced economies. Okay, in particular, the centrality of exchange rates and financial frictions that are much more important for our economies than for advanced economies. But also, we want to understand why, in what sense they are important, and what they tell us for the way that monetary policy should be conducted, right? So I'm going to actually talk about these issues, and in particular, talk about, for example, what this has meant for the quest for supplementing inflation targeting in terms of finding additional independent policy instruments. Okay? And that actually has meant for central bankers in Peru, Chile, elsewhere, to try to deploy, especially foreign exchange intervention. Right? And that's a very controversial move for a number of reasons that I'm going to actually talk about. Right? And then after we go through this discussion, I'm going to talk about some implications for the design of inflation targeting. Right? So let's actually go back to right before the global financial crisis. And those of you that are old enough may remember that right before 2008, in fact, there was this consensus in the literature and practice that every central bank should move to inflation targeting, right? I mean, this was actually written by a prominent economist from the Federal Reserve Bank of Richmond, Marvin Goodfriend, who ended up being director of research at the Richmond Fed, and then he was actually he was going to become a governor of the Federal Reserve before his untimely death in 2019. He said, the world has achieved a working consensus, right, on the core principles of monetary policy, right, and that inflation targeting yields the best cyclical behavior of employment and output and monetary policy alone can deliver. That was it. We all have to adopt that system. That was, the situation right before the global financial crisis, right? So let's actually see what he meant by this. I mean, what was meant then by inflation targeting. Right? And here I rely on the work by Lars Svensson, for example, and others that gave, I guess, a theoretical framework to understand the inflation targeting regimes that New Zealand, for example, and other advanced countries had implemented in the 90s. Right? So Svensson said, well, there are three aspects of it. One is an announced numerical inflation target. Right? So the central bank should say the inflation rate is going to be 2% per year, right? Two, an explicit decision-making framework that assigns a prime role to the implied inflation forecast in setting policy instruments. That is that, if you look at optimal policy, then you should be setting your policy instrument, and in this case, there was only one, typically, some kind of policy interest rate and interbank interest rate, in trying to hit the target in the future, right? So, and therefore, Svensson said, especially, that you should move your policy instrument according to the information that you would get from different variables in the economy, right? Let's go back to that question. And then the third, the third defining element was a high degree of transparency and accountability, right? Which has been essentially what has been implemented by the successful inflation targeting regimes. They have like regular publications. They actually tell the public why they did what they did and whatnot. But let me actually emphasize what the original framework was not about, right? So, for example, this was not about using instruments that Gertler and others called unconventional policy instruments, right? There was no rationale for such instruments. That would include intervention, exchange rate intervention, but more recently in advanced economies, quantitative easing, forward guidance, all of these instruments, they are not part of the inflation targeting regime, right? Or they were not before the global financial crisis. Also, the recipe would tell you, there's no independent reason for monetary policy to respond to financial volatility or exchange rate fluctuations, except to the point that this financial volatility or exchange rate fluctuations impinged on the attainment of the inflation target. Right? And in particular, optimal monetary policy would not prescribe exchange rate smoothing. Okay, so that's the recipe. That was the recipe, the official recipe of inflation targeting. But in practice, however, inflation targeting central banks deviated significantly from the ideal paradigm. And in emerging economies, this happened for reasons that were very different from the reasons that prompted advanced economy central banks to deviate from inflation targeting themselves, right? I mean, advanced countries, central banks brought their interest rates after the global financial crisis. They brought their policy rates to zero, and not having any more available instruments, they started doing things that they didn't know how they were going to work, right? Um, in emerging economies, in fact, the deviations were not prompted, not forced by interest rates going to zero. And in fact, um, they had started much earlier than the global financial crisis, especially in terms of foreign exchange intervention, right? So let's go back to the case of Peru, right? In Peru, this is actual intervention by the Central Peruvian Bank, right? In millions of dollars. So to give you some idea, Peru's these interventions are in the order of I guess 1/10 of the reserves, which are um, about 1/3 of GDP. So they are large interventions, and you can see that intervention in Peru started much earlier than the global financial crisis in 2008. I mean, there was quite a bit of intervention already in 2004, 2005, and 2006, right? And this was the case in a lot of other countries as well. I mean, this is a very Adler and Tovar at the IMF had this very important, interesting article where they documented foreign exchange intervention in emerging economies. And they said that in Latin America, Latin American countries were intervening about 19% of the time, right? Their cumulative intervention was in the order of 10% of GDP. And you have a number of, Peru was quite active in intervention, but other countries like Colombia, for example. Colombia is an interesting case, and that case was very important for me to start thinking about this issue because I was invited to talk about the exchange rate management in 2007. And my first reaction was, well, Colombia has an inflation targeting regime, right? And at the time, its inflation target was about 4%. The inflation rate was about 9%. So monetary policy required increasing interest rates. But at the same time, they were experiencing huge capital inflows. So that increased interest rates would have actually exacerbated the capital inflows. And then the consequence was, well, the Colombian Central Bank started intervening quite forcefully without success, by the way. They were defeated by markets. Eventually, they had to impose capital controls, right? So that's a case to be kept in mind. Okay. So as I'm mentioning, the canonical IT prescription says that monetary policy should react to exchange rate only if exchange rates provide information about the achieving the inflation target in the future. Okay? But arguably, not arguably, they say that central banks concerned about exchange rates. It's not about inflation. I mean, you can see that in, for example, the BIS has surveys of central bankers, and they ask central bankers, well, why do you intervene, right? And central bankers say, well, we intervene for these reasons, we intervene for not these reasons. Inflation is not a main reason for intervention from the viewpoint of central bankers. So what's going on? Well, in my view, and from talking to people, so there are essentially two reasons. One is competitiveness, and the second is financial stability and exchange rates. Okay, so the question that you may want to ask is, well, are these good reasons or bad reasons? Well, so what happened in the late 2000s is a case in which many central banks intervened to prevent appreciation of their currencies, right? Colombia was the most notorious case because in that case, the intervention was at odds with the overall stance of monetary policy. And the markets perceived that. I mean, when I was there, people were talking about this conflict between intervention policy and monetary policy, the overall interest rate policy, right? So that's a situation in which, the government, the central bank had to intervene. Why? Because there had been an appreciation of the Colombian peso from about 3,200 pesos per dollar to about 1,800 pesos per dollar. And then, the exporters actually came knocking at the door of the central bank to say, you have to do something about it. So that's a reason why central banks intervene. Sometimes they say, okay, I'm going to do something. right? So I can show you that I'm doing something, right? Even if I know that it doesn't work, right? I mean, that's the plain truth, right? That central bankers say, okay, I'm going to actually give you this candy, right? So, but that's actually problematic for a number of reasons. One is that there is no mandate for the central banker to care about competitiveness, right? In the inflation targeting. Um, and then intervention actually becomes confusing to the private sector about what the government has to do, and also gives the idea that the central bank is not in control. Right? I mean, that has been the situation, for example, about 10, 12 years ago, when Brazil had this problem of appreciation as well, right? And then you have the Central Bank of Brazil governor saying, well, Brazil has infinite weapons to fight the current currency wars, right? And then a few months later, he had to say, well, the currency war has been lost, right? So we give up. Um, so that's not, I mean, all of these reasons are not great reasons. But better reasons maybe for intervention, for the possibilities of intervention, is that exchange rates and financial frictions play a very prominent role in emerging economies. Right? I mean, some of the reasons having the topic of the conversations we've been having, in this conference, like, balance sheet effects and currency mismatches imply that exchange rate movements, especially depreciations, can be contractionary, right? Not expansionary, as in the text. Well, sorry, that's the kind of work that Céspedes, Velasco, and I developed. Well, now 25 years ago. Oh, that's a lot of time. And this literature, of course, has given a lot has been very, very important to give theoretical backing for a number of policy reforms. For example, the emphasis in de-dollarization, for example, was actually emerged at the same time as the literature and partly. So, okay. Now, all of this being said, you might want to actually appreciate that literature does not necessarily mean that a central bank should try to smooth or fix the exchange rates. But in fact, the literature has a lot of examples in which even with balance sheet effects and even with currency mismatches, flexible exchange rates are better than fixed exchange rates. Right? I have actually mentioned, for example, the paper that Céspedes, Velasco, and I wrote in 2004. Recently, for example, even now, in 2024, there is a working paper by Elektak and Shagarov that actually arrives to the same conclusion with some qualifications. Right? So it is not necessarily the case that all of these considerations mean that monetary policy should change, IT policy should change in response to, say, the existence of currency mismatch and whatnot. So that has led to the next question, which is, well, can we have intervention as a supplementary, as an independent policy instrument? And that, when you frame the question that way, then you have to look at the impact of sterilized intervention. Right? And then the question is, well, does sterilized intervention matter? So for those of you that you might want to recall the distinction, suppose that the central bank, say, buys reserves by, say, 100, then the monetary base increases by 100, right? So you might not want to actually change the monetary base, or so that actually means that reserves increase has to be matched by a change in the net domestic assets of the central bank, say, right? So let's keep that in mind. And then the evidence has been for some time that intervention does not matter, right? I mean, that the evidence is very discouraging, that sterilized intervention has very little influence over exchange rates. I mean, this is from the textbook by Krugman, Osler, and Melitz, right? On the other hand, there's a theory that says that under at least two conditions, that assets are perfectly substitutable or there are perfect financial markets, intervention, in fact, does not matter. So why do central banks intervene? Well, now it turns out to be the case that if you allow for financial markets to be imperfect, then sterilized intervention can matter, right? And this has been essentially the main insight of the work by Adler and Blanchard and Cavallo Filo. And the theory has been developed by Gavesh Majori and myself recently. And so let me just tell you very quickly what my own take on this was. The idea is, well, suppose that you have an economies in which, say, domestic banks borrow abroad to finance loans domestically, right? But for these banks are subject to some credit ceiling that may or may not bind, right? So if the ceiling does not bind, domestic credit is determined by demand, and the loan interest rate equals the world rate. When the ceiling does bind, however, domestic credit is actually given by the ceiling, and the domestic interest rate actually increases over the world rate. So the spread, interest rate spreads increase, right? So in this kind of situation, then this is how intervention may or may not work, right? Think about the sterilized sale of foreign reserves by the central bank. The sterilization means that the central bank has to increase credit to domestic agents, in this case, banks. Now, if the external credit ceiling does not bind, then central banks just take the increased credit by the central bank and they borrow less from abroad. So in that case, the intervention does not matter, right? If the ceiling is binding, however, the sterilized increase in credit by the central bank does increase the supply of credit and alleviates the shortage of credits exactly at the moments where this is actually needed. So intervention is not only effective, but also it's welfare improving. Right? So this is the way that actually that little model in my paper actually gives you a lot of interesting results. Like, for example, that it is consistent with previous analysis, and it explains, for example, why it is empirically so difficult to find important effects of intervention, right? And it justifies intervention only under some conditions, those conditions that financial constraints become binding. So that has a lot of implications for policy design. For example, you might want to say, well, there should be intervention in response to some information given by exchange rates, but that's actually not the best policy in this case, right? Because exchange rates move all of the time, but you want to intervene only when there is financial constraints are binding, right? So in this case, for example, a much better option in my model, in any case, is to intervene when credit spreads become larger. So so this actually squares very well with Setnam's talk yesterday, by the way, right? So when the credit spreads become larger, then they signal that financial constraints have become tighter, and therefore that's a reason to intervene. And in fact, it tells us to intervene when conventional policy would be much less effective. So this is actually where we are at. I'm trying to think about, well, how can we think about incorporating all of these insights into a new version of inflation targeting? Maybe there should be the recognition that it is at some times that, in fact, we have to depart from the conventional recipe, that the central bank should, in some sense, recognize that there are special times in which, say, financial constraints, there's financial volatility, spreads become larger, and so on, right? And then there should be the deployment of these unconventional instruments. But so, in fact, that's what the Central Bank of Peru has been doing, right? They have been intervening. When you look at this, they have been using the reserves at moments of extreme volatility, and they also buy reserves to replenish the reserves. That's another issue that actually deserves deserves attention, which is, well, all of this strategy should be complemented with the idea that, okay, so to intervene, you need reserves, right? So there should be some strategy of accumulating reserves. And you can see, for example, the Peruvian central bank has been buying reserves, not in response to depreciation, but in some sense to replenish their stock when, when the price is cheap, let's put it. But anyways, so there are some other nuances, but since I'm out of time, I think I'm going to stop here and then let you ask questions.
Thank you, Roberto, for a wonderful talk. So now we have like about 5 to 10 minutes for questions. I see Monzour's hand.
Good afternoon, Professor. I'm Monzoor Morshid from Bangladesh. Thank you for your nice presentation. Actually, I love the idea of inflation targeting 2.0 because I feel that the way it has been managed, but now it needs innovation considering the new contexts are happening. For example, currently President Trump administration have put a ban on central bank digital currency. In the meantime, the administration has mandated reserving some fund for cryptocurrency or Bitcoin. So while adopting these executive orders, there will be some pressure on central bank for all over the world in terms of inflation targeting, while the monetary sovereignty is being challenged by the decentralized digital currency. So how the central banks, all the countries will be preparing this shock because some new things will be coming that we are not ready for it. So what is your opinion on this issue?
Well, I'm not an expert on the issue, especially about the question of central bank digital currencies that you're mentioning. I mean, right now, and central banks in the ones that I've been associated with, they are only now starting to think about this issue. I know, for example, in fact, I'm quite familiar with the fact that the Peruvian central bank has a task force talking about the possibility of a central bank digital currency. But right now, that's all I can say. We don't really have much of an insight or results.
Other questions? Santiago.
First of all, amazing presentation. Very interesting in these topics. I wanted to know your thoughts about to make FX interventions matter. You need to break a little bit these UIP. You need your models to allow for these UIP deviations. And the literature has found different ways to do it. You can put dollars in your utility function. You can introduce these financial intermediaries that don't like currency mismatch, for like Shocking Mooking or Gabex Majori. So I wanted to know your thoughts about what do you think is actually happening in real life, in the data that might break this UIP and might give a role for like changes in quantities in the balance sheet of the Peruvian central bank to affect UIP spreads and the exchange rate, and how that affects the real economy in an economy like Peru, in which, I mean, 80% of the people are probably hand to mouth. So there's not an Euler equation doing a lot of these intertemporal smoothing, like how these two things might relate to each other, or what are your thoughts about that?
Thank you very much. I mean, you're right in that the ideas that I have had the time to talk about are quite general, and then if I had had a little more time, I would have asked, I would have talked about the issue, well, the actual implementation of some of the ideas. For example, one of the, no, I'm going to actually cheat and then go back to this graph that I was not, I was going to say, well, there are models and there's reality, right? So in the model it says, well, you should intervene when financial constraints bind, right? But how do I know that? Yeah, right. And one possibility is to think about indicators like uncovering disparity deviations or CIP deviations. In fact, that's an idea that Pierre-Olivier Gourinchas talked about in his annual research conference at the IMF a couple of years ago, that said, we have to actually have monetary policy or liquidity policy that reacts to what he called basis. The basis is CIP deviations, right? So which one, and in fact, these are the measures of uncovering disparity deviations, CIP deviations in Chile, for example, and they tell us different things, right? So they move differently. They must be responding to different financial frictions, and the details of the financial system do matter quite a bit, right? So I think that we will have to spend more time talking to people in central banking, financial institutions, to see exactly how, capital flows go into particular countries, and what are, I think that in general segmentation is very important, right? The fact that the typical assumption that we have is that we have these agents that can borrow in the world market. Well, what does that mean? They borrow through some doors. Let's say they have to go through some financial intermediaries. That's the Asian majority kind of idea. And then we have to identify who these guys are, right? We have to identify, how exactly are funds moving, say, from New York to Santiago and so on, right? So that's where we are at. I mean, for example, I was in Peru a couple of weeks ago talking to people at the central bank and elsewhere, and they say, by and large, dollar funds come to Peru through the mining system, right? So the mining companies actually get funding from abroad, and then they actually deposit these dollars in the domestic financial system, and that's the way that actually that becomes credit to the rest of the economy, right? So you were asking about how I think about, like, I guess the less the smaller agents, right? So I mean, that's the kind of mechanism that we want to be thinking about, right?
This might be a naive question, I'm not sure, but I'd be interested in getting your thoughts on another criteria for possible FX interventions. So you mentioned competitiveness, financial fragility. I want to imagine another scenario of an emerging economy that's not well diversified, so that there's exportation of one commodity, but then the consumption basket contains a lot of imports, so that consumption smoothing could be sometimes a justification for exchange rate intervention. So I wanted to get your thoughts on, would the issues be similar to the ones that you discussed? Would they be different? Curious to hear your thoughts.
My take is that, well, I had nothing to do with it. Sorry.
How did that happen?
Sorry. Are you okay? Yeah.
Santiago, could you hand me my phone?
Oh, what a horrible coincidence. But it gives me more time to think about my answer. Sorry.
Exactly.
My take is that some of the issues that you're talking about should be handled with conventional policy, right? But the usual policy, right? Like, take consumption, smoothing, and so on. Now, in spite of what I said, there is some work in trying to figure out whether the competitiveness aspect of exchange rate intervention might be warranted, right? There is some ideas due to I think Benigno Fornaro that said, well, if you have models of endogenous growth and then you want to, for some reason, like subsidize the I guess endogenous growth in the tradable sector, then that, by keeping undervalued exchange rates, for example, that would be a way to do it, right? And then that still doesn't answer the question how it is exactly that sterilized intervention would actually work. But the idea that trying to keep, at least for a while, the exchange rate weaker than it should have been, that it would have been, then maybe justified on welfare grounds. But I think that case needs a lot more justification.
We'll take one last question by Nur Sultan.
Thank you very much for your presentation. So in one of your slides, you mentioned that in the context of inflation targeting, to intervene, if you want to intervene, you have to have information about the inflation. And in my country's context, for instance, like 70% of our goods are coming from abroad, so we are importing, and we know the exchange rate pass-through. So we know exact information that there is a pass-through, and also we conducting like interest-based monetary policy, but still we don't have inflation targeting. So in this case, is it possible to implement inflation targeting for my country? Thank you.
I don't see why not, right? I mean, what you would need then is the appropriate model of how exchange rates are incorporated into essentially either the CPI or expectations of inflation. But I don't see why not to. In that case, for example, I would say that conventional policy, the usual monetary policy, would react to exchange rates if they have exchange rates that are giving you, I guess, additional marginal forecasting power for future inflation. That's absolutely true, but that's nothing new, right? So there is some question, for example, about whether it would be better for interest rate rules to say react to say the PPI or the CPI. Those have been dealt with in the literature as well. I can give you the references if you're interested.
Okay, so we'd like to thank Professor Chang for this very nice talk.
Thank you.
Thank you. Thank you, Roberto. And we'll move on with our second speaker of the session, Professor Michael Klein from Tufts University.